I got into crypto in 2017 and I've invested about 10,000 hours. They say that in order to achieve mastery on a subject, you need about 10,000 hours of time invested until you're a master. Now, I definitely don't feel like a master of crypto. I mean, I've gone on to turn 5K into millions of dollars, but I don't feel like you ever truly achieve mastery in crypto. But what I have achieved is a level of success that people want to achieve. They want to make enough money to never have to work again, and I've hit that level. I figured I'd make this video today to break down the 7 biggest lessons that I've learned after spending 10,000 plus hours on this industry. So if you're listening to this, take out a pen and paper, take some notes because it's going to be a longer video. Let's get started. 10,000 hours is a long time, and I've managed to squash 10,000 hours into about probably 30 minutes of incredibly valuable content for you guys in this video. So I'm going to cover 7 things that I've learned. And the number one is this concept of leverage traders are the most profitable pool of people to counter trade. So one of the biggest insights I've had is that the biggest pool of people who are the best to be making money from is the leverage traders. The leverage traders lose billions and billions and billions of dollars every single year. And it's very transparent and it's very easy to identify why and when these people are losing money, because in the industry of crypto, we've mapped out these leverage traders very well. We've got data sets that measure everything that they're doing, how much they're doing it. And I've basically collected all of this data and I use it to counter trade people who are basically leverage trading in crypto. And that's what all my systems are built off of. All the algorithms that I run, all of it is based off this one concept, this one lesson that leverage traders are probably the easiest people to make money against in the market. And so what I do is I basically just counter trade for traders. It's a very simple concept, but it works incredibly well, because what happens is that in crypto, most people lose money. So if you just do the opposite of what most people do, you'll end up making money, right? Just pretty simple. If you just do the opposite of what the people losing money do, you will make money, okay? Now, it's not as simple as that, but that's the basic premise of how it works. For example, just to show you some data sets that I use, which essentially show you how to counter trade traders, what a lot of leverage traders do is they enter these massive long positions where they put on 10x leverage, they long Bitcoin, they want it to go up to 70K new all-time highs. And in the process of doing so, they get liquidated before the market ever goes in the direction that they were expecting. Someone that's a leverage trader might be right. They might be right that we're going to go to 70K. We're at 60K now. We're going to go to 70K. The path from 60 to 70K is not going to be an easy path. Generally speaking, all these people who are long are going to have to get liquidated and then the market will move up. And that's basically what's happened on every single dip in Bitcoin. Every time we had a dip and we had the bottom, we basically had a massive amount of long liquidations. You can see here on every single dip, every single bottom, it was put in by a massive amount of liquidations to people who had long positions. And so if you just did the opposite of what these people were doing, so what they're all doing here is they're all closing their longs forcibly by the market. So if you just bought when they were selling, if you bought when they were closing their longs, you made money. It doesn't get easier than that. You just look for any spike, even ones that I didn't highlight. They were bottoms too, but they just weren't as clear as the ones that I wanted to highlight. And you can see even at the recent bottom here, we had the most liquidations that we've had since the exact bottom. And that was a massive reversal. You could have made a lot of money. Even in a shorter term long position, you could have made a 10-20% move on Bitcoin, which is not very often happening. Another way that I use this data is the Hunter algorithm system. So this is more measuring funding data. You can see that it sends signals, which are these fire triangles, the green and orange ones. And you can see here that we're basically buying the bottoms every single time, right? And these are live signals. This is not back tested. These are signals that happened at the time that they were sent. Another way that you can measure what the leverage traders are doing is open interest. So generally speaking, when we have a crash in the amount of open interest, so the amount of open positions, the amount of people interested in longing or shorting, when we have a massive crash in the price and a crash in the amount of open interest, that's generally speaking a lot of people who are long getting liquidated, because the people who are losing money and closing their positions, generally speaking here, are going to be people who are long, who have lost money. And like we said, leverage traders, when they do one thing, you want to do the opposite of them. So all of these people who were leveraged long, they got liquidated on the crash. That's when you want to start buying, because you want to counter trade the people who are losing money. And you can see that at the bottom here, big open interest crash, big open interest crash, same sort of concept. And then the last piece of data that you can use with all of the ones I just showed you is not necessarily measuring leverage traders. This is more just measuring the amount of bids and asks in the order book at particular periods of time. And you can see here at this bottom here, you can see that we had some liquidations. And what we also had was a lot of bids, right? You can see on this sliding scale, the higher the color, the more the amount of bids, okay? If it's above the price, then it's an ask. So it's, sell orders. And if it's below the price, it's the buy orders. And so what I've found is a beautiful combination to basically make money doing the opposite of leverage traders is when you see a lot of leverage traders getting liquidated, a big spike, and you see price going into an area with a lot of bids. That's basically free money. Because what this is saying is that the price has crashed to the extent where everyone who was trying to long Bitcoin has now sold, and all that selling pressure is now gone because the longs are liquidated. So all the sellers are done. And what happens now is that prices entered a level where there is a lot of people who are willing to put in a wall to stop the price from dropping any lower. And the way that a bull market works is bull markets happen off the back of a lot of people who haven't yet bought. This is why bull markets follow this concept of the wall of worry, right? A bull market goes up like this, and the only reason that the bull market can continue is when you have this wall of worry, which is a lot of people who are scared about macro, COVID, whatever the narrative is. There has to be a lot of people scared to be doing something at any period of time. And what ends up happening is you have a lot of people who haven't bought, who place bids, and as long as there is a big bid wall on every single dip, then the bull market can continue basically. And that's what we see here. A lot of people wanting to buy. Everyone who was going to sell has already sold. It's the perfect setup for a bottom. So just remember this. This is the key lesson here. When you have long traders liquidated into a massive bid wall, it's a no-brainer buy. It's as free money as money gets. When you're looking at chart data, right, there's two main ways that people put data on a chart. When you go on YouTube and you look at most of these YouTubers, they're going to look at shit like RSI. They're going to put the relative strength index. They're going to put the MACD. They're going to put the Bollinger Bands. They're going to put Elliott waves. They're going to use what I would call chart data. Chart data is data that uses price and volume for the calculation. Now, I've found that using price and volume can be useful to a certain extent, but what I found is the best data in crypto is the data I just showed you. It's what I would call the trader data. It's data that measures what the traders are doing or what people are actually doing in the market. So for the bids and asks, you're measuring, are people looking to buy or sell? Open interest is basically measuring like how much interest is there open currently in the market in longs and shorts. This is basically measuring the funding data, so the sentiment of people who are opening positions. And this is measuring how many people have been forced to close a particular position, right? Long or short. And this data is much more accurate in my opinion. And so that's the lesson that I've learned. Trader data is much more accurate. There's much more alpha to extract, money to extract than chart data. I think it's also less competitive. Most people are all focused on chart data. They're all focused on Elliott waves. There's more of an edge here. A really good way to put this is that short-term price action is dictated by the derivatives market, and the long-term price movement is dictated by the spot market. And I did a drawing to help visualize this. So the red is what the actual price of Bitcoin does, and the blue is like the underlying value. And what I find is that price continually goes a lot above and a lot below the fair price, because that's the path that the price is going in order to liquidate and to over the most amount of shorter term time framed people. And also obviously people in the market over and underestimate the value of something. We're never going to be able to know the fair value in the moment. But this is what happens. You have all these people who are in short term positions getting liquidated left, right, and center. Price is moving wherever it can over the most amount of people. And then you've got the actual underlying value slowly going up and then down at times. And this is actually a lesson from one of the books I wrote a couple of years ago, and it just sums up what I just said. Because 1 to 3 times a year, this is more alpha for you guys, you get a massive unwind in leverage positions. And this is, generally speaking, a buy the dip opportunity. So this is why it's actually important to keep cash on the sidelines at times, because maybe once a year, maybe more, you get this massive crash where it just gives you this amazing buy opportunity. We had one in COVID. We had that crash during the FTX debacle. We had an amazing crash here back in January. That offered an amazing opportunity before we went up. You get these happen sometimes, and you just got to keep some cash on the side for these. That's the first lesson from 10,000 hours on crypto. It's those pool of people are very profitable to do the opposite of. The second thing that I learned after 10,000 hours on crypto is that thinking in, I knew I should have done this or I knew I should have done that, it's going to ruin you as an investor. So what people often say, Daniel, I knew I should have bought. What do I do now? Or I knew that was the top. I should have taken profits. I knew this coin was going to underperform. I should have swapped to this one. I knew this new shit coin was going to be a rug. I should have just not bought it. Or I knew I should have put more in. I had conviction. I didn't put weight behind it. People are always, in hindsight, able to see where they went wrong. And the funny thing is that every day you have 70,000 thoughts on average. And when you make a decision to buy or sell or swap or whatever you're doing in the market, you're always considering all the possibilities up front, generally speaking. So before you went and bought something, you also thought about the other side of the equation. What if you didn't buy it. You would probably have considered the argument for doing the opposite of what you decided to do. And you do this every time you make a decision. You will go, okay, should I buy or should I not buy? And you'll think about both sides of the argument and then you'll make a decision. And afterwards, if you go, oh, I knew I should have done this, you didn't, because you had considered both sides before you made the decision. And at the time, that was the best decision you could have made. So looking in hindsight after a decision has been made and saying, I should have done this, I should have done that, isn't going to improve you as an investor. It's the wrong way to think about things, right? What you need to think about instead is about how well did you execute your strategy. If you followed your strategy and you lost money on the trade or the investment, that's a good thing. A losing trade when you followed your system is a good thing, because no system has a 100% hit rate. If your system has a 90% hit rate, you're still going to have losing trades where if you executed it well, it was a good trade. So that's not the problem. The problem isn't losing. The problem isn't, oh, I should have done this. The problem is, did you follow your strategy? Did you even have a strategy? What was the edge that you had when you made that decision that you did? I think that's a much more important thing that I found to focus on after spending all this time on crypto than using hindsight as a way to sort of punish yourself. You're not going to get everything right. You just need to look at over a sample size of 100 investments, 100 trades, or 1,000. Is what I did today going to make me money? Yes or no? Well, yeah, I followed a system which is going to make me money, and I just had one losing position, which is inevitably going to happen. So the answer is yes. And then you're fine. I think that's a better way to view things. And there's a guy on Twitter, Kun, who made a tweet which relates to this. A lack of process leads to a reliance on hindsight bias as a strategy. Oh, last time I saw this and it kept going up. That's not a process, and you will get trained by the market like a dog to develop certain habits by the dip. Once you believe it can't go wrong, it does. Okay, so let's read this first sentence again. A lack of process leads to reliance on hindsight bias as a strategy. So when you don't have a proper strategy behind what you do, you rely on what recently happened in order to dictate your decisions. Let's say you don't have a process and you bought something recently and you lost money on it. You're going to focus really heavily on that investment that you made that you lost money on to dictate what you do in the future. And the problem with that is that if you listen to the most recent thing that went wrong, you're going to program yourself to learn the lesson of what went wrong and are going to apply it one step ahead of you, and it doesn't work. Let me show you why. In a bull market, you get programmed to buy dips, right? But by the time you're ready to buy the dip, it is the beginning of the bear market. If you bought here and you said, oh, I should have bought the dip, bought here, should have bought the dip, bought here, should have bought the dip, by the time you're buying the dips, the bull market's over. You need to be buying the dips before you can look into hindsight and say, I should be a dip buyer. Because the market, and I'm going to talk about this more later, the market will program you with the right lessons at the wrong time. This is what I found in my experience. By the time that I've really learnt a lesson, the market taught me that lesson at the time when I least needed it. At the end of a bull run, when you truly understand the idea of buying the dip, is the time at which you least need that knowledge. Trust me, by the time you're a great dip buyer, you do not want to be buying dips. That's the beginning of a bear market. And that's what happened to me in the 2020, 2021 bull run. I got programmed as a dip buyer. I was like, I'm fucking great at buying dips. And then the dip just kept dipping in 2022. And that's when you get caught offside. So this is why often you need a full market cycle in order for you to be a profitable investor. Because if you haven't experienced the full market cycle, then you're going to take each recent lesson that you learn as if it should be applied at all times in the market. You're going to learn the importance of buying dips, and you're going to apply that across 5 years. But buying the dip is only a concept that you apply maybe 2 out of 4 years. But you don't understand that until you've seen the bear market and the bull market and the sideways market and everything in between. And that's sort of what I've learned. It's like when you get programmed by the market with certain lessons, you got to be careful about the time at which you're using it, because if you use it at the wrong time, you're going to lose money. Lots of investors get trained by the market to act a certain way at the point where it is too late to do so. The market teaches you the right lessons at the wrong times. And this is a good way to visualize what I just explained. When the bear market is at its peak, so let's imagine this is the bottom of the bear market, this is the top of the bull market. At the end of a bear market, the uptrend is beginning. But you have this bear bias. At the beginning of a bull run, when the bear market's ended, what you start thinking to yourself is things like, oh man, what I've really learned is I need to take profits. I need to sell quickly. I need to not hold positions for a long time. And I need to be really, really careful and not risk too much. That's what you think after a bear market has happened. What you don't see coming is the next wave of the bull run. Then the same thing flipped the opposite way. When you've gone through a bull market and the bull market's ended, you're applying your bull bias at the wrong time. So you're going to start saying things like, you got to take a lot of risk. You got to use leverage. You got to buy on dips. You got to hodl. You can't sell too early. You got to hold for the 50x gains. That's what you start telling yourself. By the time these lessons are learnt, it's too late. This is the third thing that I've learned. after 10,000 hours of crypto. In the stock market, they talk a lot about this concept of it's all about time in the market. It's not about timing the market. And I think for the stock market, it makes a lot of sense. You can get away with in the stock world to just hold things for a long time and you will eventually make a profit, because if you buy the S&P 500, eventually it'll make a new all-time high, pretty much guaranteed. In crypto, for pretty much every single coin, this same concept doesn't work. You can't just buy any shit coin, spending time in the market just holding it for a long time and then make money. It doesn't really work. So what you need instead in crypto is you need to be both really good at timing and you also need to be getting time in the market. Both of these concepts are important and you need to be able to balance both, because timing, if you are too careful with it, you're going to never buy. You're going to miss the entry. But if you're just too focused on just buying something and holding it for a long time, you're also going to yourself over, okay? So let's talk about this. This is what stocks generally look like. You have like this only up price action, and you have occasional crashes, and then it just goes back to only up. And so the concept of time in the market is really important in the stock world. Makes sense, because if you bought here and then it went down, eventually you're just going to be back in a profit pretty quickly and you'll be fine, right? That's the stock concept. But in crypto, what tends to happen is something very different. What you have is, let's say you buy a new altcoin. The chart looks like this. You buy it here, and then it goes down 90%, and then it goes sideways. In the stock market world, eventually the index will go to a new all-time high. But in crypto, what tends to happen is the coin never reaches its prior bull market highs. So often you'll get these little pumps like this where the coin will go up 3 to 5x, but it will never, ever, ever go past its all-time high. It never goes up there to this level. It gets maximum like halfway. Look at any of the altcoins from like 2018. You'll notice this. They have a really good first bull run, and then the second bull run just never goes past the first one. Now, there is some exceptions to this. For example, if you bought BNB in 2018, it just kept going up. So it had its first bull run. You can see the first bull run down here. And usually it goes through its first bull run and then it dies off. And then it gets to here and then it dies off again. And it never goes past this level. BNB was an exception. Generally speaking, if you're holding an altcoin, 99% of the coins never went past their old all-time highs. You're sort of betting against the trend there. So what I've learned is that with my investment process, when I'm coming into crypto, I have to come in with the mindset that it's really important to get the timing right, and it's really important to hold the coin for a long period of time. And it's really important that I balance both of these and I don't go too heavy on either side. Because crypto is so volatile that if you don't time your entries, you will go through multiple years of 70, 80, 90% losses, and you might not even get ever back into a profit, because most altcoins are not going to make a comeback. Now, Bitcoin is a small exception. Bitcoin can be expected to just keep making all-time highs because it's now tapped into the ETF world. So we have a permanent bid from the wealthiest financial institutions, their wealthiest clients. Everyone in the world is getting into Bitcoin. So you can expect Bitcoin to be a little bit different from most of these altcoins. So the concept of just time in the market, hodl with Bitcoin is fine, that works. It's just the altcoins that I'm talking about here. And you can see the importance of time in the market with Bitcoin. On this graph here, the purple is just 10 of the best days for Bitcoin. And you can see here that if you take out 10 of the best days of each year of Bitcoin's price movement, most years you lost massive amounts of money. So if you're too careful with timing, you actually potentially lose some of the best profit days, which massively reduces the asymmetry of your returns. So for altcoins, what's the lesson? 10,000 hours of learning has taught me that for altcoins, the timing is super important. Holding the coin, so time in the market, is also important, but you can't venture into bag holder territory. You have to be able to cut your bags if they're not doing what you think. And you have to put an expiry date on when you sell any altcoin. So for example, you might say to yourself, I won't buy an altcoin that has existed for more than 3 years. And if my altcoin, I hold it for longer than 16 months and I have to sell it and find a new one. That might be a mindset that you have. If you hold past expiry, it's near impossible that you ever end up in profit. And also, you have to understand the tokenomics for the altcoin market doesn't make sense. You have massive token inflation from teams, VCs, insiders getting massive unlocks, inflating the token to death. And you also have stakers making money who have to sell the token to cover costs. And then you have what also happens in a bear market, which is the demand goes to basically zero for risk. And you just get this perfect setup where basically every altcoin goes down 80, 90% or more because you have massive inflation, so massive supply issues, and then massive demand problems. Stocks in Bitcoin is time in the market, much more important than timing, especially for stocks. You hold long enough, you're going to see a profit. The fourth thing that I've realized, this is less about 10,000 hours in crypto, and this is more a lesson of networking. This is more a lesson that I learned from being at levels of the game where you see how crypto truly works. This is what I've learned from conversations with multiple billionaires, people who run some of the biggest projects, people who launch some of the biggest meme coins, people working on the teams of the biggest decentralized exchanges, all these different things. This is where this lesson came from. So if you look at these two photos, there's a hierarchy, and the hierarchy begins with whoever gets to make money first. The first person to make money is on top of the hierarchy. So obviously the team makes money first, right? Because they raise money and they get profit before anyone else. The second in line is the VCs. Maybe they have to wait for their tokens to unlock, but generally speaking, they get such a cheap price on their tokens that they're able to make profits. What you also have next is the KOLs and the smart retail. So the influencers who promote the coins and smart retail who can get in early, they are then next on the hierarchy. And then at the bottom is dumb retail who just gets shat on by everyone else and they don't get to shit on anyone else, right? In this graphic, you only make money if you get to shit on someone else. And it's like in a Ponzi scheme, you only make money if someone joins after you. This is basically a reverse Ponzi pyramid. So you have it like this. You only make money if there's a section of people who join after you, people who are below you. And it's the same thing here. First, the alpha goes to the Telegram inner circles, and then the Discords get it, and then people talk about it in the DMs, and then small Twitter researchers find it, and then people shill it on Twitter, and then there's you. So you just get the culmination of everyone else's shit at the bottom. And you have to basically ascend the hierarchy, and the further that you can go up this hierarchy, the more money that you can make. If you only get one level up, you're sweet. You can make millions of dollars. In fact, I am here. This is me. I'm not the team. I don't launch projects. I'm very rarely a VC. This is me here. You only have to get up one level and you're making millions, okay? So the way that I view crypto after 10,000 hours is I really feel like it's just the world's largest, massively multiplayer online game. And it's essentially a 24/7, never-ending, never-closing battle for resources where people create clans, they make weapon and armor, and they're basically doing whatever they can to make as much money as possible and to win the game. And if you've got weak armor in the game, or you're not in a clan, you try to run around solo, you can still win, but it's a lot harder to. So I want to give you some examples of ways the game is rigged, of ways that the people at the top basically guarantee that they make money. So one of the ways they rig the game is the KOL Insider Playbook. So a new token wants to launch and they go, how are we going to get people to buy our shitcoin? Well, they go to the influencers. They contact all the influencers and they say, hey, we'll give you a % of the tokens and all you have to do is talk about our coin. The influencer gets really cheap tokens or they get free tokens and then they talk about the coin on their social media. Sometimes they even get a bonus for if they reach a certain market cap with promotions. They'll say, we'll give you an extra 0.5% of the supply if you pump our meme coin to 50 million market cap. And I've seen this happen first place with a bunch of meme coins. Like there was one that happened like 2 weeks ago. Like this is a very common thing. And no matter what happens, the coin could go up, down, do nothing, could collapse. The KOL always makes profit. The team doesn't matter. The token could die next week, but they will always make money. But the people who end up getting wrecked is the retail, who are basically the people who buy last. They don't have an edge in being an influencer. They don't have an edge in launching a coin. They're just the last person to buy. And then they get dumped on, generally speaking. Sometimes they make money, but generally they just get dumped on. And so what you'll also see is you might see some big influencers with advisory roles for some of these companies. An advisory role is really just purchased reputation. It's just when you're a coin and you say we're endorsed by or we're advised by this guy, you're basically just paying for his audience to have a positive association with your brand. There's not really much advisory going on. There's not really any value they provide outside of just having the stamp of approval. It's basically like getting an FDA approval that, oh yeah, this product is good. It's the same thing. Now, another way that they rig the game to basically guarantee that they make money is they create clans, like in a video game. I used to play this game called Combat Arms, but Combat Arms was like a shit version of Call of Duty for free, and there was clans. Inevitably, what ended up happening is that all the really, really good Combat Arms players just started meeting each other and networking, and they all joined a clan together, and then they would fight the other clans in clan battles, and the best clan would win. And anyone who wasn't in a clan just had no chance of winning, because when you're in a really good clan with other people who are also really good, you combine resources, you combine talent, you combine your brains, and you're just way better than others. You're all talking to each other on the phone like there's an enemy on flag B, go over there. It's just a much smoother, more likely to win experience. And the same thing happens in crypto. Smart people talk online on Discord, Telegram, Twitter. They form little groups, and then they share alpha amongst each other. Now, in the group, when alpha is shared, sometimes the alpha leaks to friends. And then once the friends are in, once everyone's bought something, they then share it in their paid groups. And after the paid groups are bought, they then put it on Twitter. So by the time you see someone talk about a coin on Twitter, you have to keep in mind that that information has already circulated in all these higher groups that get earlier access than you. So by the time you see it on Twitter, you're the last guy to buy, generally. And that's why if you've ever gone and bought a coin because someone said to buy it on Twitter, it often doesn't make you money. You often buy it too late. Sometimes it might go up 50% past where they say to buy, maybe 30%, 2x, 3x. But generally speaking, if you buy something because someone on Twitter said to buy it, you're the last in the hierarchy to get that information. And also, Twitter is a place to flex. And you can only flex if a coin has made you money. So often, by the time you see someone talking a lot about a coin on Twitter, it's because the coin has gone up a lot and they can flex on you. I used to do this. When Toshi was going up a lot, the more it went up, the more I tweeted about it. Whereas you, the viewer, you might think to yourself, the more he tweets about it, the more I should buy it, which is wrong. It's just, oh, it's gone up more, so I flex it more. And that's why if everyone's bloating about a coin making the money, it's probably the wrong time to buy it. For example, Nero. I'm sure that there is some sort of a cabal, some sort of a team that launched this, and then they told their friends that they launched it. And so the friends are all buying down here, and then they told their friends, and then the paid groups find out, and then they bloat about it on Twitter when it's at like a 200 million market cap, when they were buying it probably at like 10, 20. And I don't know who this guy is, it's just a random example. But this is sort of what you would see on Twitter. It wasn't put on Twitter down here, it was put on Twitter over here. That's what makes it tricky. And there's one more playbook. So a big incentive for employees at startups is vested tokens. This is a very common thing in the traditional finance world. If you're an early employee at a tech startup like Google, if you're the 5th employee, you were given a % of the shares, and then there is a vested and they get unlocked over time. Same thing in crypto. You're like the 4th employee of a decentralized exchange. You would get vested tokens, which get unlocked in the future. Now, when you think about how many projects there are in crypto, and you think about how many employees they have, you realize that there's probably tens of thousands of people who have tokens that are vesting, which they will probably sell when they get unlocked. And this is hundreds of millions, maybe billions of dollars of value waiting to get unlocked for people who are employees. So they're probably not wealthy people. In fact, one of my friends, he works for a project in crypto. He was one of the first employees. He was given a massive amount of vested tokens. It turned him into a millionaire. But these are, keep in mind, locked tokens. And as they begin to get unlocked, he's going to have this 100K of money he has. And then he's going to have like $1 million of vested token that are getting unlocked. And he's going to say to himself, hold on a second, I'm a millionaire now. Do I really want to keep all my money in this crypto project that I work for? Do I want to keep all of it, or should I probably sell half? The logical thing is, okay, I should sell half due to how massive a % of their net worth is in it. And this happens for hundreds, if not thousands of people. If you're working for a startup, you're probably not quite there yet, but obviously, after working for the project, you do. And so that's just an explanation of how they rig the game to make sure they make profit. Tens of thousands of people work for crypto startups on the marketing, product design. They get vested tokens. And that's how projects can get away with lower salaries if they just give a larger % of the token supply. And that's a good way for them to hedge risk. As a project, you give less upfront and you give them more if it works out, and it sort of aligns incentives better. So what I've learned after 10,000 hours is that the game is rigged to the people who exist at the top. And here's just a few different ways that I've seen the game rigged. Now, I have 4 different ways that you can go about sort of putting yourself in the best possible position now that you know this information. You can spend money to buy your way into these circles. So there's some paid groups which are pretty good, which you can join, and you can get information that is better than what you see online. You can network your way into these circles. So you can become good enough at crypto where you just start networking, going to events, joining high-level Discord communities, talking to people, and you'll just naturally join these circles. That's what I did. You can become so good that you don't even need a clan. You don't even need other people. You can just invest yourself. I have friends who basically day trade for a living and they don't rely on anyone else for anything. They're multimillionaires. They can just do everything themselves. Or the last thing you can do is you just become the house. And that way you don't have to actually be good at anything crypto. You just have to be good at business. And you can rig the game in your favor, because in a game where most people lose, if you just take a small percent of every participant, you will win no matter what happens, as long as people are playing the game. Now, the fifth lesson I want to talk about is second guessing everything. I would say that there's pretty much no good actors in crypto. Of everyone that I've followed on Twitter over the years, most people eventually slip up and fuck up and do something that's unethical. Even myself, I'm definitely not a perfect good actor either. Almost every influencer, from what I've seen, has taken money to promote a coin. Most coins, they make the founders rich without delivering any real world value. There's hundreds of people out there who became a millionaire off of a coin they launched and they didn't bring any value and they didn't refund anyone. They don't care that people lost their life savings on their coin. They became millionaires, they're now rich, others are now poor, and they're okay with that. There's so many people like this. It's insane. Most teams lie about their competence to boost valuations. So a lot of projects will just create an entirely fake team behind a project, putting AI photos of people with fake names, fake faces, everything. But they'll talk about all the big things they're working on. A lot of it is just a facade. And scams, they come out in full force anytime a sector of crypto gets hot. So when meme coins pop up, all the scammers come to meme coins. When NFTs were hot, all the scammers came and launched NFTs. All the influencers make NFT collections, they all go to zero. Almost every single individual in crypto is partially here to get themselves rich. So with any person that you aim to trust, keep this context in mind, and you have to ask yourself, what's their financial incentive for what they're doing, right? If there's an influencer you follow, even me on my YouTube channel, why am I trying to help you? Now, most influencers, they try to help you because they shill coins. They get paid to talk about a coin, and then they don't tell you that they were paid to talk about a coin. So then you hear them talking about a coin, and you think, oh, he endorsed it, it must be good. No, he just got paid, doesn't give a fuck. Some people shill paid groups. I run a paid group. That's what I'm here for. What's my financial incentive? I run a mastermind teaching people crypto and my strategies. That's my financial incentive. Other people share affiliate links to Bybit, Binance. Other people, they launch meme coins or their own project, whatever it is. So the question is never like, is this person trying to make money from me? The question is, how are they making money from me? Because almost every influencer, everyone in crypto is trying to take money from you in some way. And if it's not one of these 4 methods listed, the way that an influencer is trying to take money from you is from the market. Because if they make money on a coin and you lose money, you basically gave them the money yourself. It's always a game of you losing, them winning, or them losing and you winning. Now, I think that if you look at how someone is making money from you and you think it makes sense, then there's no problems. For example, I think that someone who runs a paid group is actually not a problem. I think if someone shares an affiliate link, I think that's not a problem. I think a non-disclosed shill of a coin is bad. I think launching coins generally is silly because you're not qualified to make this thing work. But if someone runs a paid group, they're incentivized to make you money, because the more money they make you, the more you tell your friends and the better the testimonials, the more money they make from more people joining. So there's an incentive alignment there. But when someone is paid to promote a coin, there's not necessarily an incentive alignment. If the coin goes up, it increases their reputation, but these guys don't really give a fuck if the coin goes up. They will still get people wanting promotions. All the people care about is the views. Are you a high viewed YouTube channel? That's what they're looking for. So yeah, you have to look at the incentive alignment. This person who's in crypto, teaching me about crypto, what do they want? And is the information going to be fair because of this? I think that's a good way to look at it. Lesson number 6, everyone gets what they deserve. I've seen people become billionaires. I met Andrew Lee at a conference. He's a billionaire that basically just bought Bitcoin. I've seen people lose decades of life savings gambling on meme coins. I've seen people make and lose millions. I've seen people make millions and keep it. I've seen every unique situation. Every single situation, every single person got the same thing that they desired. They all got what they deserved. The billionaire, who's still a billionaire, dedicated his life to markets. He dedicated his life to building and supporting Bitcoin by building projects within the Bitcoin ecosystem. For example, look at Andrew Lee. He created a number of different Bitcoin ecosystem projects. Pretty sure he created Lightning Network. He designed a private decentralized Uniswap. He's done a bunch of other things. So these guys dedicate their lives. They bet early on something that's going to be massive, and they see big success because of that. The guy who lost his life saving, he didn't consider the risks up front. He put his life savings savings in. He had a full-time job. He tried to balance crypto on the side, didn't have a proper strategy, didn't have years of experience, bet everything on the line even though he was a beginner. He deserved that outcome. He deserved to lose everything because he didn't have a proper strategy. The gambler who made millions and lost it all, who had a great time, he had a massive rush of adrenaline. He got what he deserved, which was a fun time, right? And obviously he's probably a bit sad that he lost his millions, but truly at his core, he was a gambler. He wanted fun. He got what he wanted. You're never going to get out with more than you deserve. You're not going to get out with more than you aimed for in crypto. So whatever your actions reflect is what you're going to end up with. What I recommend after all this time I've spent on crypto is you guys have to look at yourself and reflect on what are you here for? What are your actions showing? If you just look at what you do every day in crypto, think about what outcome that daily work you do on crypto deserves. Is that the path of a billionaire? Is that the path of a millionaire? Is that the path of someone who's going to gamble everything away? Is it the path of someone who's going to lose their life savings? What path do your daily actions take you on, and where does that path lead you? What destination? There's a guy that messaged me this week and he said, Daniel, I opened a leverage long and I've lost all this money. I didn't have a stop loss. What should I do? And I said to him, if you used 10x leverage and you didn't use a stop loss and you didn't have any sort of premeditated idea of where you would consider the position worth closing, where it was an invalidated trade and you just were going to hold that thing through thick and thin as if you're a hodler, you're gambling. And what I told him to do is you have to take crypto either really serious or just have fun with it. So with his position that he lost all his money on, he either has to gamble and have fun or close the position and start taking shit seriously. Start using a stop loss, start journaling every trade, start building out a strategy if he was to be a trader. He has to think about what he wants and then do that, because the market is a mirror which will expose you for who you truly are at your core. You actually learn a lot about yourself when you start investing. A lot of people are very greedy, and when they come to the market and they make millions and they lose it all, they realize how greedy they really are, where they made $2 million in 12 months as a beginner and they didn't take a single dollar of profit, not even $1, pulled out to their bank account and they lost it all. They could have changed their parents' life forever, but they decided no, the greed was more important, more was needed. So the markets are very much a mirror and it will show you who you are. So that's the end of the video. If you would like to learn more about crypto from me, there's a link in the description below to where I post daily rants in a Telegram group. So if you want to just learn every day about stuff like this, I'm constantly putting valuable information in that Telegram group. I recommend you join it. But yeah, thank you guys for watching. See you in the next video. Cheers.